Hello there. Today I want to show you a technique that I use myself as far as finding the optimal profit-taking level from an intraday point of view. All right. Whenever you are taking trades, well, you need to set up your entry point, your stop loss level, and your profit-taking level, right? So what I'm going to show you is what I do myself whenever I am taking intraday trades. So I make sure that I achieve two goals. First goal is to make sure that my target is going to be hit within the trading session. If you are trading, if you're taking an intraday trade, you need to make sure that your target also remains in line with the time frame that you are trading. Okay, so if you take an intraday trade, your stop loss or your profit-taking level should also be hit within the trading session, right? Well, we are going to make sure of that. And second, we are going to make sure that at least we capitalize with the we capitalize from the major move that a currency pair has to offer for that day, right? You want to leave as few pips as possible on the table. You want to capitalize on the major move for the day. Well, we are also going to make sure that we are going to squeeze as many profits, as many pips as possible from that daily major move. All right? Okay, I'm going to show you the technique right now. Let's get going. All right. Well, first of all, of course, you need to check out the long-term charts just to verify that there is no level of support and resistance that may meddle with your trade. For example, let's assume you are looking to take an intraday trade, a long intraday trade, that being your entry point, and then you take a look into the 4 hours time frame chart, the daily or the weekly chart, and you notice that there is a downtrend line coming in there, or perhaps a major turning point, all right? And therefore, well, we have a horizontal level of support and resistance just ahead of your trade. All right. Well, you want to make sure that you have enough breathing room in between, obviously, your entry point and that particular level of support and resistance, so you can at least squeeze some healthy profits from an intraday point of view before actually reaching to this support and resistance whereabouts. If there is indeed a long-term level of support and resistance ahead of your entry point, you want to make sure to locate your final target before actually hitting, or before actually price hits that level of support and resistance, just to avoid a potential bounce of that level. Right? You don't want to give all these pips back to the market, and therefore you want to make sure to exit your target, to exit your trade, or to locate your final target before actually hitting that that problematic area of support and resistance on the longer time frames. Okay, that's the first thing you need to check out whenever you actually take a trade. Now, assuming that there is indeed no long-term level of support and resistance just ahead of your entry price that may actually meddle with your trade, well, if that's okay, then we will actually focus on the two elements, the two tools that I use in order to set to locate my intraday trading profit-taking levels. I personally use the average daily range, or average true range. It's exactly the same thing. Some people call it average daily range, some others average true range. You may also see it as ATR, okay, which is a standard indicator that most charting platforms provide for free. And also I use the round numbers. I like to blend these two elements, okay, the average true range and the round numbers, because they work best whenever you actually combine them together, right? As far as I am concerned, I strongly believe that round numbers do work as psychological levels of support and resistance from an intraday point of view. If you have a round number here, and then, well, you have another round number, this, for example, for the euro against American dollar, this being 140.00, this being 139.50. Another round number above would be 140.50, etc., etc. You know, every 50 pips, well, there's obviously a round number. In my experience, once price hits a round number, you can either see a bounce or a breakout. And if you see a breakout, price tends to gravitate towards the next one. All right, round numbers do work as decision-taking points from an intraday point of view, and once you actually hit the next one, you can either see another bounce or a breakout. And if you do see a breakout, price tends to gravitate towards the next one. All right, towards the next round number just above. That's because many traders locate their buy and sell orders around these round numbers. Okay, there is heavy trading volume waited to be punched into the market around these areas, and therefore whenever price actually hits one of those levels, well, it's a decision-taking level, and therefore, well, price is bound to either react if the sell orders located around this round number are larger than the buy orders. In the obviously, conversely, if there are more buying orders waiting to be well, to be executed at that level, then price will break through and price simply will gravitate to the next one. Okay, so there are some sort of magnet points, some sort of friction points. If price breaches one round number, expect price to crawl towards the next one. If it bounces, well, expect price obviously to bounce to the one located immediately below. All right. Now, as far as the average daily range goes, well, the ATR is nothing but the statistical average of how much or how far any currency pair moves within a trading session, within a trading day. Okay, basically what we are measuring here is the statistical average between the low and the high of any particular currency pair from a daily perspective. Usually we consider either the last 7 days worth of price action or the last 14 days of price action. I personally use 7. Okay, I like to see how much price in pips. Okay, how much in pips, how many pips price has moved from its lowest point to its highest point from a daily perspective throughout the last 7 days. So if, for example, day 1, price moved 192 pips, okay, or ranged 192 pips between the day's low and the day's high, then the next day over, well, it moved 170. Then 2 days later, it moved 220 pips, and so on and so forth. And therefore, finally, you can extract, obviously, a statistical average, right? Let's assume 185 pips on average. That means that that currency pair, from a statistical point of view, usually gives out 185 pips range, all right, from its lowest point to its highest point per individual trading session or daily trading session. Now, how is that information useful? Well, it is useful because you know, or at least from a statistical point of view, you know how much a currency pair, how many pips that currency pair has to give from an intraday point of view. You know that if you take a trade and the distance between the low and the high for that particular day is only been so far 100 pips, you know that from a statistical point of view, that currency pair has still to move 85 pips, right? So you can potentially squeeze, well, quite a nice intraday profit still. However, if by the time you take your entry, the distance between the low and the high for that particular day has been, I don't know, 210 pips, you know that you should not be taking any further entry anymore. How is that? Because that currency pair has already moved more than what it usually does from a statistical point of view, all right? And therefore, you would be taking a trade or potentially entering into a trade that just doesn't have any juice left for the day, that it has run out of steam, run out of gas, and therefore, well, you may take an entry and price simply may stall sideways for the rest of the day simply because it just doesn't have any more gas, okay? That currency pair has moved way over its statistical average, and from then on, from that moment on, well, there may be no more momentum left in the market, again, because it's already run most or even beyond its average daily range.